Everyone thinks motion equals progress. It doesn't. Motion is often the enemy of progress, especially in investing. I learned this watching two friends destroy their relationship over money, not because one cheated the other, but because one couldn't understand how doing nothing could beat doing everything. Their names were David and Michael. Both started investing on the same day in March 1995 with exactly $50,000 each. Both were intelligent, well-read, and convinced they understood the market. But their approaches couldn't have been more different. David believed in action. He subscribed to 5 financial magazines, watched CNBC religiously, and read every book on investing he could find. His apartment was cluttered with annual reports, charts, and printouts of stock analyses. He had opinions on everything: tech stocks, emerging markets, currency fluctuations, Federal Reserve policies. David lived and breathed the market. Michael, on the other hand, bought shares in 3 boring companies, Coca-Cola, Johnson & Johnson, and Microsoft, and then did something that seemed almost criminal to David. He forgot about them. He didn't check prices. He didn't read financial news. He just went about his life as a high school teacher, completely indifferent to the daily drama of Wall Street. For the first few years, David felt vindicated. He was up 40% in his first year, while Michael's portfolio barely moved 8%. David would call Michael with updates, almost lecturing him about market opportunities he was missing. "You're leaving money on the table," David would say. "The NASDAQ is exploding. Tech is the future. You're being too conservative."
Michael would listen politely and change the subject. This frustrated David even more. How could someone be so passive about their financial future? How could someone not care about optimizing their returns?
By 1999, David was feeling like a genius. He had caught the dot-com wave early, rotating in and out of internet stocks with impressive timing. His portfolio had grown to over $200,000. Michael's boring dividend stocks had plodded along to about 7. The gap was massive, and David couldn't resist reminding Michael whenever they met for dinner. "Look, I respect your approach," David would say, pulling out his portfolio statements. "But the numbers don't lie. You could be doing so much better if you just paid attention. The market is rewarding innovation, not these dinosaur companies you own." Michael would nod and order another beer. He seemed genuinely uninterested in David's success or his own supposed failure. This wasn't humility or politeness. It was genuine indifference to short-term results. And that indifference would soon prove to be the most valuable trait an investor could possess. The crash of 2000s changed everything. David watched his portfolio collapse from $240,000 to $60,000 in 18 months. The tech stocks that had made him feel brilliant were now worthless. Companies he had researched extensively simply disappeared. His carefully constructed strategies crumbled as the market turned against everything he believed. The psychological impact was devastating. David couldn't sleep. He obsessed over every news headline, every analyst recommendation, every rumor. He was caught in a vicious cycle, selling at the bottom, buying at temporary peaks, always trying to time his way back to even. Each decision seemed logical in isolation, but collectively they were destroying his wealth. Meanwhile, Michael's boring companies kept paying dividends and quietly recovering their share prices. He didn't know his portfolio had dropped to $65,000 and then climbed back to $80,000. He was too busy teaching chemistry and coaching the debate team to notice. By 2005, something remarkable had happened. David's account, despite his constant attention and sophisticated strategies, had recovered to only he had essentially treaded water for a decade. The markets had generally risen. Michael's neglected portfolio, meanwhile, had grown to. The gap had not only closed, it had reversed. David couldn't understand it. He had made dozens of smart moves, had timed several market cycles perfectly, had avoided numerous disasters through careful analysis. Yet his friend, who did absolutely nothing, was pulling ahead. It didn't make mathematical sense, but it made perfect psychological sense. David's need to act, to optimize, to stay engaged, was slowly bleeding his portfolio through transaction costs, timing errors, and emotional decisions. He was like a surgeon who couldn't stop operating even when the patient was healing naturally. The 2008 financial crisis provided the final brutal lesson. David, convinced that his experience in 2000 had made him wiser, tried to trade around the volatility. He sold everything in October 2008, certain that worse was coming. He was right about the direction, but wrong about the timing. When he finally bought back in during 2010, he had missed most of the recovery. Michael's portfolio dropped along with everyone else's from $180,000, but since he never looked at the statements, he never felt compelled to sell. By 2015, 20 years after they started, the final tally was devastating for David's ego. His account showed $140,000.
3 times larger.
From identical starting points, identical time periods, and access to identical information. The only difference was that one man couldn't stop moving while the other couldn't be bothered to start. The friendship ended not in anger, but in bewilderment. David couldn't accept that his superior knowledge, constant attention, and sophisticated strategies had been beaten by someone who treated investing like a savings account. It challenged everything he believed about markets, intelligence, and the value of hard work. Michael, for his part, remained genuinely puzzled by David's obsession. It's just money sitting in stocks, he would say. Why would I worry about it day to day? I don't check the value of my house every morning. That simple statement contained more investing wisdom than all of David's research combined. Michael understood intuitively what David never learned, that the stock market is a voting machine in the short run, but a weighing machine in the long run. The daily votes are cast by fear, greed, and hope. The long-term weighing is done by earnings, dividends, and business fundamentals. David spent 20 years trying to predict and profit from the voting. Michael spent 20 years ignoring the votes and trusting the weighing. The market rewarded patience over intelligence, indifference over engagement, boredom over excitement. This isn't a story about luck. It's a story about human nature and the cruel mathematics of compounding. Every time David traded, he faced the possibility of being wrong. And in markets, being wrong has a cost, not just in money, but in psychology. Each mistake made the next decision harder, more emotional, more likely to be wrong again. Michael faced no such pressure. His 3 companies continued doing business while he continued teaching. Their profits compounded while his stress remained at 0. He never had to be right about timing, never had to predict the unpredictable, never had to overcome his own emotional reactions to market drama.
The paradox of patience is that it feels like laziness, but performs like genius. It appears passive, but generates active returns. It seems boring, but proves exciting in the only way that matters, in the final accounting.
Most investors never learn this lesson because they can't tolerate the psychological discomfort of inaction. They confuse activity with productivity, motion with progress. They need to feel in control, even when control is an illusion. They would rather lose money actively than make money passively. The market exploits this need ruthlessly. It provides endless opportunities to act, infinite information to process, constant reasons to adjust and optimize. It whispers that if you just pay closer attention, just stay more informed, just react more quickly, you can beat the patient money that sits still. But patient money has advantages that active money can never overcome. It doesn't pay transaction costs. It doesn't make timing errors. It doesn't panic in bear markets or get greedy in bull markets. It simply sits, collects dividends, and benefits from the long-term growth of human productivity. The most expensive words in investing are, I must do something. They lead to overtrading, market timing, sector rotation, and all the other activities that feel productive but prove destructive. The market charges a premium for this illusion of control, collecting fees and spreads from every unnecessary transaction. Warren Buffett once said his ideal holding period is forever. Most investors think he's exaggerating for effect. He's not. forever eliminates all timing decisions, all second guessing, all the emotional turbulence that destroys returns. It's not just a strategy, it's a philosophy of surrender to the power of compounding time. The patience paradox applies beyond investing. In careers, relationships, and personal development, the urge to constantly optimize often prevents actual optimization. The student who changes majors every semester rarely graduates with distinction. The person who switches jobs every year rarely builds deep expertise. The investor who changes strategies every quarter rarely builds wealth. Patience is not passive. It's actively choosing to endure discomfort rather than seek relief. It's actively choosing uncertainty rather than the illusion of control. It's actively choosing simplicity rather than the complexity that feels more intelligent. David made one fundamental error. He confused being busy with being productive. He thought that because he was working harder at investing, he should get better results. But markets don't reward effort. They reward patience. They don't care how many hours you spend researching. They care how long you can sit still while they do their work. The truly painful part of David's story is that he wasn't stupid or lazy. He was intelligent and hardworking. His failure wasn't a character flaw. It was a misunderstanding of what markets reward. He brought an employee mindset to an owner's game. Employees get rewarded for activity and responsiveness. Owners get rewarded for patience and judgment. Michael succeeded not because he was smarter, but because he was more comfortable with uncertainty. He could live with not knowing what would happen next quarter or next year. He could tolerate the anxiety of not optimizing every decision. This tolerance for uncertainty gave him access to returns that certainty-seeking investors can never reach. The market is fundamentally a mechanism for transferring money from the impatient to the patient. Every trade has two sides, one person buying, one person selling. One of them thinks the price will go up, the other thinks it will go down. One of them is probably wrong, and that wrongness usually comes from impatience rather than ignorance. Professional traders understand this dynamic and exploit it ruthlessly. They know that somewhere out there, an amateur investor is panicking about a temporary price drop or getting excited about a temporary price rise. They position themselves to benefit from this emotional volatility, collecting small profits from countless small mistakes made by people who can't sit still. The amateur investor's disadvantage isn't lack of information or analytical tools. It's temperament. They want to act when action is expensive and avoid action when action is cheap. They buy when everyone is optimistic and sell when everyone is pessimistic. They consistently do the opposite of what patience would dictate. This is why investing success correlates so weakly with intelligence and so strongly with emotional stability. The smartest people often make the worst investors because they can't resist the temptation to use their intelligence. They want to analyze, predict, and optimize. They can't accept that sometimes the smartest thing to do is nothing at all. Michael's success wasn't an accident. It was the inevitable result of avoiding the most common investing mistakes: overconfidence, overactivity, and the need for control. He didn't avoid these mistakes through discipline or willpower. He avoided them through indifference. And indifference, it turns out, is a superpower in investing. The cruel irony is that David would have been far wealthier if he had simply bought the same 3 stocks as Michael and then lost interest in investing entirely. His curiosity and engagement, the traits that made him successful in other areas of life, were liabilities in the market. They led him to solve problems that didn't exist and optimize systems that were already optimal. This is perhaps the hardest lesson for intelligent people to learn, that there are games where trying harder makes you worse, where caring more leads to worse outcomes, where the optimal strategy is to stop playing actively and just hold on. Investing is one of those games. The patience paradox reveals a deeper truth about wealth building. It's not about maximizing returns, it's about minimizing mistakes. David spent 20 years trying to maximize returns and ended up minimizing wealth. Michael spent 20 years minimizing mistakes and ended up maximizing wealth. Every investor must choose between the satisfaction of feeling smart and the satisfaction of getting rich. You can have market-beating analysis or market-beating returns, but rarely both. David chose to feel smart. Michael chose to get rich. The market honored both choices exactly as they deserved. The most successful investors in history share one trait: they can tolerate being bored. They can own the same stocks for decades without feeling the need to change anything. They can ignore market commentary, analyst predictions, and the daily noise that makes investing feel urgent and complicated. Boring, it turns out, is a feature, not a bug. Boring companies with boring business models producing boring but growing cash flows create exciting wealth over time. Exciting companies with exciting prospects and exciting volatility usually create boring wealth or losses. The market will always offer opportunities to trade patience for action, simplicity for complexity, boredom for excitement. It will always suggest that if you just pay a little more attention, make a few more adjustments, respond to a few more signals, you can improve your results. This suggestion is almost always wrong. Michael understood what David never learned, that the market's job is to serve patient capital, not to reward clever traders. Companies exist to generate profits over decades, not to provide entertainment for speculators over quarters. By aligning his timeline with business fundamentals rather than market emotions, Michael accessed returns that emotional investors can never sustain. The patience paradox isn't really about patience at all. It's about understanding what kind of game you're playing. If you think investing is a game of prediction and timing, you'll trade constantly and probably lose. If you think investing is a game of ownership and compounding, you'll buy rarely and probably win. Most people never figure out which game they're playing. They drift between the two, trading when they feel smart and holding when they feel scared. This inconsistency guarantees mediocre results because they're playing both games poorly instead of one game well. The deepest insight from David and Michael's story isn't about investing, it's about human nature. We are wired to value action over inaction, control over surrender, complexity over simplicity. These instincts served us well as hunter-gatherers, but work against us as investors. The market ruthlessly exploits our evolutionary biases, charging us for the privilege of feeling busy and important. Successful investing requires going against these instincts. It requires doing what feels wrong, sitting still while others trade, staying simple while others complicate, remaining patient while others panic. It requires treating your natural impulses as signals to do the opposite. This is why so few people build serious wealth through investing. It's not because the strategy is complicated, it's because the psychology is unbearable. Most people would rather feel smart and lose money than feel stupid and make money. They'd rather be active participants in their own mediocrity than passive beneficiaries of business success. The market doesn't care about your effort, your intelligence, or your dedication. It only cares about your behavior. And the behavior it rewards most is the one that feels most like giving up buying good businesses and then ignoring them while they do what good businesses do, compound wealth over time.
20 years later, Michael still doesn't check his account balance. He still doesn't watch financial news or read investment newsletters. His portfolio has grown to over $800,000, and he remains as indifferent to its daily fluctuations as ever. He succeeded not because he learned to invest, but because he never learned to trade.
David, meanwhile, continues searching for the strategy that will finally deliver the returns he knows he deserves. He's tried value investing, growth investing, momentum trading, and options strategies. He's read every book, attended seminars, and subscribed to premium research services. His account balance fluctuates between $120,000 trapped in a cycle of modest gains followed by emotional mistakes. The gap between them widens every year, not because Michael is getting smarter, but because David can't stop trying to get smarter. The market rewards the former and punishes the latter with the relentless efficiency of compound interest working in two directions. In the end, patience isn't about waiting, it's about understanding. Understanding that businesses take time to compound, that markets take time to recognize value, that wealth takes time to build. Once you truly understand this, patience stops feeling like deprivation and starts feeling like strategy. Most investors are trying to compress time to get next decade's returns this year, but time cannot be compressed, only borrowed from, and the market charges compound interest on time borrowed. Better to expand your timeline than to leverage your returns, to think like an owner than to trade like a gambler. The patience paradox teaches us that in a world obsessed with speed, the greatest competitive advantage might be the ability to slow down. In markets that reward quarterly thinking with quarterly volatility, the patient capital that thinks in decades doesn't just win, it wins by margins that seem impossible until you see the mathematics of compounding stretched across time. Michael won not because he was patient, but because he was indifferent. And indifference properly applied might be the most powerful force in investing, more powerful than analysis, more reliable than prediction, more profitable than intelligence itself.